By the way, Alexandro, I don't know if you are here under a different name, so please just let me know such that I can give you co-host privileges.
Bom dia.
Bom dia, Ricardo. Okay, it's time for us to start. We're still missing one of the speakers, but the other is on. So we hope that the issue will be solved promptly. First of all, let me present myself. My name is Francisco Ferreira. I'm the president of the board of Zero, Association for the Sustainability of the Earth System. It's a Portuguese environmental NGO, and we're part of the LIFE ETX project, a project supported by the European Commission under the LIFE program. Today we'll have another ETS talks, so on the European trading system. And as you know, this is a cornerstone of the European Union's energy and climate policy. By putting a price on CO2, it creates incentives to reduce emissions. As the carbon prices grow higher, the better the prospects for the climate transition, as in theory, the polluter pays principle is applied and companies put more effort into reducing emissions. By the end of 2021 and beginning of 2022, the EU carbon prices were reaching record high levels, culminating at 95 euros per ton on February 23rd. But the complex interlinkage of different factors and dynamics affecting carbon prices on the EU ETS, including geopolitical and socioeconomic developments, and unfortunately, in the past months, marked by the unlawful invasion of Ukraine by Russia, a geopolitical development that has had severe social, economic, and political repercussions, also became a considerable factor in relation to the price of CO2. The beginning of the war in Ukraine saw a steep decrease in the price of carbon allowances in the EU, despite the ramping up of fossil fuel prices. The price went from 95 euros per ton to 58 euros per ton in around a week's time, a staggering decrease of about 39% in a very short period of time. However, prices have since consistently recovered to higher levels, and the EU carbon price now sits around 81 euros per ton. So even though a price collapse seems quite unlikely, the carbon price has been gripped by volatility, and in fact, analysts argue that the only certainty is the uncertainty. Nevertheless, it is in this third ETS talk, we will try to shed some light on the market dynamics and the factors that influence the carbon market prices, so that in the midst of the uncertainty, we can at least identify possibilities going forward. And for that, we do have two expert analysts on carbon markets with us today that will certainly enlighten all of us on these complex issues. So we'll basically start with two speakers, Alexandru Vitelli and then Ingvild Soros. And then we have a debate. We believe that this ETS talk will take from 1 hour to 1 hour and 15 minutes. And we hope, a large participation from all of you. So thank you, all of us, to be with us. And I will actually start with giving the floor to Alexandru Vitelli. Alexandru holds a Bachelor's of Arts in Politics and French from the University of Reading. He is an experienced carbon and energy markets reporter, market analyst, and editorial manager. He has covered UN negotiations, energy trading, regulatory issues, and sport news. So, Alexandru, welcome, good morning, and the floor is yours.
Thank you. Nice to be here. Would it be possible to share my screen, please? I have a little short presentation.
Absolutely. You're co-host, so you should be able to share the screen.
All right, I'm going to try. Oh, hang on a second. I need to grab my browser some access. Does look like it's going to work for me, I think.
Are you sure?
Well,
because you should be able to share the screen. If not, do you want to send me your slides such that I can present?
Sure, let me just quickly do that for you. Apologies for the interruption.
Okay, maybe what we can do is, Alexandru, I just sent my email such that you can send the slides if necessary. What I would propose is that we start with Ingvild, and then we go to you. Is that okay, Alexandru?
Right by me. I apologize for this.
Okay. So now I would like to present Ingvild. Ingvild holds a Master of Science in Bioinformatics from the Norwegian University of Life Sciences. She has broad experience in climate policy analysis and has followed carbon markets since 2007. Since 2018, she has been a senior analyst at Refinitive, providing insights to clients on EU ETS. Ingvild, are you here?
I'm here. Thank you so much. And hopefully you will I'm able to share my screen now, right?
Yes, you just have to go to full mode. But we're already looking at the screen. Perfect.
There you go. Thank you so much for the invitation. It's exciting times to be a carbon analyst, and I mean it has been for a while now, when carbon is a bit higher up in the agenda than like 6-7 years ago, when prices were almost neglectable. But today I want to talk about kind of the war in Ukraine and the impact on the EU ETS, bit on the short term and bit on the longer term, as we see it. I worked at Refinitive, previously known as Point Carbon, Thomson Reuters, Refinitive, now an LSEG business, but still kind of the same. We are delivering independent carbon analytics with a team here based in Oslo, and we also have a big team in Beijing. But this is not what I'm going to talk about. This is carbon price, the European carbon price. And I guess we already been through this slightly, but I'll kind of dive a bit more into it. I mean, last year was kind of a bit unprecedented when we came to carbon prices. I mean, we saw an increase of almost 150% throughout the year. And mainly, I would say kind of there are several factors of why this happened, but the main reason was kind of this surge in gas prices, energy prices in Europe. And really kind of starting the year, we also had high prices. We were kind of approaching 100 euros per ton. And I guess reporters like Alessandro Vitelli and others like him were kind of preparing this story, when will it hit 100 or not, kind of that it was hitting 100. But instead we saw a correction. And then when the invasion happened, we really kind of saw carbon prices crashing and hitting 55 before they now has rebounded and stabilized around 80 euros per ton. We're still kind of now at the levels where we were in January, December. So it's not kind of, I mean, even though we were close to 100, it's still kind of at quite high levels. And the interesting thing is that kind of the increase that we saw last year was really kind of, it was also happening because you had this kind of surge in gas prices. What we kind of have seen now with the invasion, that carbon was really decoupling from the energy complex. While carbon was crashing, then the gas, coal prices, they were just surging. So this chart is kind of showing a index performance to 1st of February. So it's more easier to compare kind of the increase and decrease in the various contracts. So kind of those that goes up to 200, 250, 300, that's kind of the API coal contract for the front year. And then it's also the gas, TTF gas contract for the front month. And what we kind of saw that was carbon was moving in the opposite direction, not as extreme as the energy contract, but it still kind of saw a large decrease. And it was also kind of more taking direction from equity markets than really kind of the fundamental picture. Why this happened? I mean, it was several reasons why we think that happened. One thing is kind of liquidation of EUA positions. Those are kind of market participants that were exposed to various or other energy commodities as well, had to kind of liquidate some of the EUA positions to cover margin call that they were exposed to in energy. Then it was kind of also this kind of immediate reaction, someone saying, well, will climate policy now be put in the back seat instead of kind of, will it be a delay to Fit for 55? Will anyone kind of talk about EU ETS? Kind of this concern that climate policy was kind of going down on the political agenda was kind of one factor that might be kind of why it was dropping. And then, of course, high electricity prices, high energy prices, the worry that that will cause demand disruption, that would again lower lower emissions in the EU ETS. We also could have had kind of some industrials that were kind of cash constrained with free allowances on their account, that they possibly had to kind of sell some of their positions to kind of raise cash, even though kind of in the long term they will kind of still need those allowances to cover their emissions. We also saw, I mean, the EU ETS has been, I mean, for various reasons, it has become kind of a attractive asset for those that don't have compliance obligations, those that are not emitters in the EU. And we also saw kind of international investors minimizing the exposure to not necessarily kind of only EUAs, but European assets as such. So then kind of this snowball effect kind of just rolled and really kind of saw some unprecedented decline in the carbon price. But as we have seen, it's now kind of recovered back to 80. So we're kind of roughly around where we were in January, December, which was kind of at high levels still. Another thing that is kind of the war in Ukraine is kind of, we're talking more about kind of coal phase in than coal phase out. I mean, we had kind of the already, and of course, security of energy supply is key. I mean, the reliance on Russian gas, that's a risk for Europe. So of course, kind of, we have seen now countries kind of talking about the possibility to delay planned coal phase-out plans. Also, there has been kind of some discussions, should some of the decommissioned coal plants be brought back to life to kind of replace some of the, or kind of to replace some of the gas burn in Europe. Market is also pricing in sustained high gas prices, which is kind of still worry for kind of the electricity prices across Europe as such. I mean, last year we saw higher coal burn. I mean, verified emissions are coming out on Friday, so then we will have the answer to what emissions was actually in 2021. We expect kind of power sector emissions to have went up 12 or more than 12%. In the short term, because last year also we saw a higher coal burn because of this like squeezed gas market. But of course, we think this will continue and kind of will be amplified by kind of the situation in Ukraine. Also, Timmermans also said kind of he's also saying that coal is not a taboo. Rather stay kind of slightly longer with coal and then immediately move to renewables instead of doing kind of the transition step via gas and that will kind of still be within the boundaries of climate policy. So really saying that, okay, our goals are fixed, we can survive kind of a short-lived coal, more coal exposure in Europe. We're still within the boundaries of the climate policy. This chart to the right is just showing the CO2 switching price from 36% efficient coal plants to 50% efficient gas plants. Just wanted to kind of take that in as well. So this is really showing that this is for various forward contracts in the market at the moment. When this CO2 switching price is above the EUA price, so the carbon price, then it's more profitable to run the coal plants. And we really saw, I mean, that was much of the picture last year as well, that the carbon price was kind of far off to trigger any fuel switching. Because you didn't have sufficient gas to cater for additional demand from the power sector. So really kind of in 2019, that was really the anchor. The carbon price was kind of very linked to how high did the carbon price need to be in order to switch from coal to gas. But at least kind of second half of last year and really kind of this year, we don't see any kind of that will actually take place, that we will have a shift in the situation where gas will really be in the money compared to coal plants. So really kind of, so that's kind of on the power sector side, roughly half of the emissions in the EU ETS. But on the other hand, we see possible demand disruption to hit Europe. I mean, the high energy prices, I mean, has been kind of flagged by industry already kind of towards the end of last year. High electricity costs, high gas prices were kind of forcing industry to stop or limit production, has been even kind of more flagged now, that industry sectors have raised concern that these high energy costs are causing them to reduce or could force them to reduce production. We're also kind of looking at a risk of economic downturn, Russian sanctions, high commodity and food prices. Ahead of the war, the European Commission came out with a winter outlook saying that economic growth in the EU is expected to be at 4%. Then I guess like a bit more than a week ago, or a bit more, saying that they are certain that these expectations will be subject to downward revision because of kind of the Ukrainian crisis. But of course, kind of lower economic activity, lower industrial activity will then lead to lower emissions in the EU ETS. So on one hand, we're looking at power sector where you kind of favor coal plants, favor kind of those more high emissions, high emitters. And then on the other side, we might see that industry is struggling. Industry will kind of reduce production, which will again lower emissions. Coming a bit to kind of the longer term, and I mean, we're in the middle of the Fit for 55, kind of how to adopt the, or how legislation should change to be fit for 55. I would say kind of that the things that hasn't changed is really kind of climate ambition is still strong in EU. In 2030, well, I mean, we have at least 55% emission reductions from 1990 levels. We have the climate neutrality goal for 2050. I mean, they're in the climate law, so, and we see no changes to the climate ambition. So the underlying kind of support from the climate ambition in Europe is still strong. The EU ETS is kind of the cornerstone of the European climate policy. We have seen kind of strong confidence, especially after 2019, when the market stability reserve really kind of started to soak up the oversupply in the market. But it's kind of brought back that the EU ETS is really kind of a strong confidence as a policy instrument and delivers a price signal that will actually take Europe, the European economy, to where it's supposed to be in the future. So long-term view is still supportive for the EU ETS. However, what has changed is really kind of willingness to increase the renewable ambition. We have seen kind of political groups now coming out saying we are kind of want to kind of speed up the renewable take up rather kind of sooner rather than later. And also the European Commission, when they came out with this Repower EU, that the green transition is the answer to a lot of the concerns around energy supply and the reliance on Russian fossil fuel. So this is also kind of focusing on kind of the more rapid take-up of renewable power generation, which kind of in the longer term will mean then faster emissions reductions for sectors in the EU ETS. It's also going to focus on the revenue on EU ETS, like front loading, possibility to front load the innovation fund to actually push the shift that is needed at a faster pace than before. So you could say kind of going forward, that's, I mean, climate ambition is strong, is kind of on the supportive side, and then faster emission reductions is kind of on the laxing side, or kind of the bearish side of things. But I would say I have had to bring up the market stability reserve as well, because I said it was kind of the turning point in 2019. I mean, the task of market stability reserve is to kind of then to address the surplus of allowances, and also kind of improve the system's resilience to major shocks by adjusting supply of allowances to the auction. And we really saw that kind of one brought back confidence in 2019, but it's also kind of acted as a safety net when emissions were hit due to COVID in 2020. So that was really kind of the test of the second goal of the market stability reserve. So in that sense, the market or market participants know in the short term, I mean, if we kind of end up with a year that we will kind of see an increase in emission, potentially due to coal, kind of more coal burn, that will mean that MSR will hold back less allowances, kind of to balance a bit the market. That's kind of the task of the market stability reserve, and vice versa. If you will see kind of emissions dropping severely because of demand destruction, then it will take up more allowances. So it's really kind of this balancing act is kind of, it will kind of be tested in practice also so this year. But also again, for the long term, I mean, if we will see a more rapid greening of the power sector, it will also kind of address the surplus. So it will actually work on that surplus as well. So kind of the negative impact, if you can say negative impact, but the kind of the bearish impact on prices will be less severe than if market stability reserve was not there in the first place. Because I mean, European Commission came out or kind of have proposed to still continue with a high or with an ambitious market stability instrument, also kind of in the Fit for 55 debate. So it's really kind of the tool that makes the impact less severe, both kind of in the short term, but also kind of on the longer term effect of the Ukrainian war. Want to kind of sum it up, we have seen kind of a short-term decoupling of the energy complex. It seems to be kind of rather kind of short-lived. There was a shock, but now it has recovered again, and then we'll see what happens kind of throughout the year, if it goes then back to more kind of following the more fundamental picture again. We're looking at the year where we can kind of see higher power sector emissions. So we're kind of allowing more coal burn or kind of to avoid the Russian gas in Europe. It's kind of demand disruption in industry. That's kind of a risk. But it's also this kind of willingness to speed up the green transition to lose dependence on Russian fossil fuels, which is kind of supportive of the climate ambition and kind of on the policy debate around Fit for 55 and Green Deal. Yes, and then it's the MSR that is kind of keeping the EU ETS balanced. So I think that was short kind of from me on the impact on the Ukrainian war.
Thank you very much, Ingvild, for your presentation. It was quite clear, and now we will have Alexandra that I already presented, and I will show the slides. So Alexandra, whenever you want me to move on, just let me know.
I'll do that.
You should be seeing the slides right now.
Yep, thank you. Thanks everybody. I wanted to go into a little bit more of detailed view of how the market actually establishes a price on a daily basis, and then what decisions companies are taking when they decide to buy or sell in this market. So can we move to the next slide, Francisco, please? Thank you. Just to provide some historical context, this is what the price history of carbon looks like since 2008. In fact, as you can see, it's taken a long time for the reform of the market to actually grip, if you like, the participants and to persuade them that we are going a little bit higher. So the next slide, please, Francisco. One of the things that this market has suffered from over the years has been oversupply. The initial calculation of how many allowances should be given out and made available to the market was somewhat, let's just say it wasn't exact, and so a lot of the allowances that were handed out in the first few years really didn't need to be there. As you can see, verified emissions here, expressed by the red line, were below the actual total number of allowances in circulation for many years, and it's only lately that we've begun to see this situation correct itself, thanks to the operation of the MSR, thanks to the reforms of the market, and thanks to increased ambition from the European Union. Next slide, please. Thank you. What I wanted to compare here was the impact of the decision of the European Union to allow the use of international carbon offsets in the market. On the left-hand side, you have the supply in blue and the demand in red, expressed only for the EU allowances. And on the right, what you've got is the supply expressed in red, including the use of international offsets. And what you can see is that the market, if we move to the next slide, Francisco, we can see that the international market generated a significant surplus in the market. On the left-hand side, we have the overall aggregate balance in the EU ETS if we look at just EU allowances. And as you can see, the balance is now more or less on an annualized basis flat. If you go to the right-hand chart, you'll see that the outstanding oversupply, which is in fact the historical, what we have today, is still something like 1.5 billion tons long. This is what the Market Stability Reserve was invented to deal with, and this is what it's hopefully going to start dealing with even better in the coming years. But the state of play right now is we still do have that surplus in the market. Next slide, please. So supply is being addressed by a number of different things. We have the MSR, which takes out about a quarter of the calculated oversupply each year, all the way out till 2030. The 24% rate of withdrawal is currently being reformed so that it extends, instead of ending next year, it ends in 2030. The market, the reforms to the market also adjusted the rate at which the cap, the number of allowances given out, is reduced each year, and that reduction has increased from 1.74% to 2.2% every year between last year, 2021, and 2030. And going back to that historical oversupply, the European Union decided to end the eligibility of international units, certified emission reductions and emission reduction units. They are no longer eligible for use for compliance. Consequently, they have all disappeared into the voluntary market. Next slide, please. So when it comes to actual decisions to buy, in the short term, you have utilities who are hedging their forward power sales 1, 2, or 3 years ahead. For every megawatt hour of forward power they're selling, they're securing in the futures market usually the coal or gas and their carbon. So there's buying decisions that are being taken up to 3 years in advance. Some of their power supply, some of the power capacity is not sold in advance. It's kept until the month ahead or the week ahead before it's needed. And there's a degree of prompt hedging that goes on as well. So they are selling power for next week or next month, and then they're buying prompt gas or coal, and they're buying carbon. Industrials are beginning to become more active participants in this market. Historically, of course, they always got more or less exactly what they needed in terms of EUAs. They were handed out free of charge every year. But the Commission has been slowly tightening the screw on industrials, and now they're beginning to get fewer and fewer allowances free of charge. This means they have to come into the market to buy. So they now need to develop a strategy. When do I buy? How much do I buy? And what we're seeing is, at the moment anyway, that whenever the price dips sharply beneath the year-to-date average, you start seeing industrials coming back into the market and buying. And some of them are not just buying for the current year, they're buying in advance because as we've discussed many times in the past, the EU ETS is a market that is really only going one way. As the targets get tighter, as the supply of allowances gets smaller, the prices are going to go higher. Everybody's made that same decision. And so industrials, when they have the ability, when they have the spare cash, they will buy for future years. It's not a significant portion of the market, but it is growing. And we start to hear more stories about industrials who are saying, let's put these in the bank for next year or the year after. There's also, of course, the action of investors and speculators in this market. Now, there are speculative investment funds who come in, who take a position in allowances, expecting the price to go higher. And in 2018 and in 2021, they did spectacularly well. At the same time, they are also very, very vulnerable, not vulnerable, but sensitive to better investment opportunities elsewhere. So in the first couple of months of 2022, when prices were not increasing all that much, they did go to a record 95, but they didn't push on after that. After that peak was reached, the investment funds started reducing their positions. Obviously, the conflict in Ukraine was a major cause of a lot of that selling, but there were also other markets that were behaving far more erratically, and there was far more volatility in those markets. Take natural gas or power, for example. And so there was a certain degree of cashing in your EUA money and going to put it to work in some other markets. But they are also looking long term. There are a number of investment funds and even instruments who invest in carbon to buy and to hold long term, because they do see this as a long-term play that will pay off for them. There's also buying decisions are driven by fundamentals such as the fuel mix. So, for example, at the moment, gas prices are far, far higher than coal prices are in terms of megawatt hours of power generated. So it makes sense to be burning coal rather than gas if you're a utility. Because coal is twice as carbon intensive as gas, you need to buy more carbon allowances. So there is also an element of what's the fuel mix, who's burning more coal, then the price is going to go up. The weather also plays an important role because, as you can understand, if it's colder, there's more heating demand, so there's more demand for gas and even coal in some places. There's also economic activity. As we're seeing now, we're beginning to see some concerns about industrial output in Europe, about a general recessionary influence. And if industrial output declines, there's less demand for EUAs from factories. So they will also be watching the data that comes out, say industrial production data or economic sentiment data, and that will also play a role in whether or not people are buying carbon. Next slide, please. So in addition to those sort of very economic, very financial decisions, we also have policy decisions, as Ingvild has expressed. The policy outlook, the Fit for 55 program, that is a really influential issue for the market at the moment. We're looking at, will we extend the ETS to include maritime emissions? Will we be looking at an even steeper annual reduction in the cap? Will there be a one-time adjustment to the overall supply of the market just to bring it more into balance? These are all issues that are on the table actively in Brussels at the moment. And so traders will be looking for any signals coming out of Brussels that might suggest whether the market is going to get much tighter or just a little bit tighter. And that will drive exactly how they're going to behave in the market. The MSR reform. I mean, the MSR is not, it's not a secret, and it's not a particularly, should we say, I don't know, it's not much up much for debate. The European Parliament has already come and said we'd like to keep it at 24% all the way to 2030. And I think there'd be more surprise if it didn't do that. So that's the kind of thing that the market looks at and puts in its back pocket and says, yes, I'm assuming that's going to happen. The other big issue, of course, is the carbon border adjustment mechanism, which is, strictly speaking, it's not part of the EU ETS, but it will have a very big impact on the EU ETS. You're going to see a system whereby importers of carbon-intensive goods and materials are going to have to pay for the carbon content of those materials. That's going to be in a shadow market to one side, but which is going to use the price of the EU ETS. So if you're bringing in steel from India or cement from Turkey, you will be assessed the carbon content of that material, and you will have to buy special CBAM allowances that are priced at the prevailing EU ETS price. This raises an opportunity for those importers to hedge their exposure to future CBAM costs by buying in the EU ETS and holding those allowances as a hedge against what they're going to have to pay when they bring in materials in the future. So there is going to be an additional source of demand there from these international companies if CBAM becomes law. And it's something that we really need to look at very carefully, because we need to judge exactly how much additional demand there could be. In addition to these policy elements, we have long-term demand forecasts as well. Analysts, including Ingvild's colleagues, put out forecasts for the market balance in coming years, the annual shortfall of allowances that's going to be every year going forward till 2030. And these, again, will also dictate to some investors and some participants whether they buy now or buy later and how much they buy. Next slide, please. There's also day-to-day elements that affect how people act in the market, literally from 1 minute to the next. You have EUA options, which are a major part of the market at various times of the year. There are quarterly options contracts where you can buy the right to purchase or to sell EUAs at a specific price, and the cost you pay for buying that option is much, much less than actually buying an EUA. And therefore, for many people, it's an extremely efficient way to get a large position in the market. And these options, they are pretty volatile, because if you have the science of options trading is something that I haven't completely mastered, but I do watch it and I do get told about it a great deal. And it can have a very, very outsized influence on EUA pricing, especially in the remaining days before an options contract expires. The other thing that we're going to see, in fact, on Friday this week, is the release of the annual verified emissions data. This is the 2021 data that the Commission has been collecting, and it will publish it hopefully on Friday. And that will show us exactly how much demand for EUAs there was in 2021, and will give us another picture into how the market is doing, how the industry in Europe is doing coming out of the COVID pandemic and coming into this period of economic uncertainty, where the impact of higher energy prices may be reducing demand. So it's going to be one of those things that people look at, and the market may react very sharply to data like that comes out. So there are also other set pieces, should we say, slightly less significant data that come out on a more regular basis, a more frequent basis, and those also can generate quite a lot of activity and movement in the price. The daily auction of allowances, which happens at 10 o'clock every day, in fact, it happened a quarter of an hour ago, that also can move the market significantly as well. The amount of participation in that auction, the demand for the EUAs that were on offer, the difference that the auction price had compared to the prevailing market, secondary market price at that time, can also generate quite a lot of volatility in this market. So people do pay attention to the auction. It's the one thing that happens every day, and is regarded by many traders as being the sort of the #1 price discovery moment in the market every day. So it's a very influential event, and a lot of trading goes on around the auction. You have people who can buy and sell allowances at the auction price, but not actually in the auction. There's a separate little shadow market which operates called traded auction. And that can be very influential too, because you can hide a lot of demand outside the auction in this traded auction facility. And therefore, maybe you don't influence the auction price so much. So it's quite strategic, and there's a lot of thought that goes into how people participate in the auction or in the traded auction facility. Next slide. The other thing, of course, is power generation margins, and I referred to these earlier, but I wanted to show this slide to show you exactly how volatile this market has been since last summer. The black line here gives you a representative profit, operating profit for a coal-fired power plant with a thermal efficiency of 38%. The blue line is the operating profit for a gas-fired plant of 50% of efficiency. And as you can see, for a long time, gas was marginally in favor back in 2020, and that meant effectively that the price of carbon was persuading utilities to burn gas instead of coal. And then as the Ukraine situation began to develop, the gas price rose higher, which we'll see in a subsequent slide, and the coal price didn't rise as much, meaning that coal became more profitable than gas. And at one point, on a front month basis, that is generating power for next month, coal was earning as much as 290 euros a megawatt hour in operating profit. Gas, on the other hand, is barely making money at the moment. It did lose money for a while, and it's barely making money now. Next slide, please. To flip that chart, the previous chart on its head, this calculation looks to establish what does the price of carbon need to be in order to get gas back into the power mix. As the previous slide showed, coal makes much more money than power at the moment, therefore than gas, and therefore gas is not the preferred fuel. And the price at the moment would have to be something in the region of 200 euros, depending on the thermal efficiency of the plant, to make gas more profitable than coal. The black line at the bottom of this chart shows you the actual price of allowances, of EU allowances, and the colored lines represent where they would need to be to get gas back into the mix. So you can see there's an awful lot of work that carbon would need to do. And frankly, politically, it's not certain that people would actually accept carbon going to where it needs to go to get gas back into the mix. So it's one of those situations whereby we know what carbon needs to do, the market knows what carbon needs to do, but nobody really wants to do that. Next slide, please. And this is basically showing the clean dark spreads and clean spark spreads. That on the left, that is the operating profit from coal for power generated next year, in 2024, in 2025, and 2026. And it shows you that the economics of power generation change the further ahead you look into the future. And as you can see, next year, 2023, the blue line in the left-hand chart, coal is still very firmly the more profitable fuel. And at the same time, you see in 2024, it's just making money. But 2025 and 2026, coal is not making money. On the right-hand side, you'll see the gas, the front year, the blue line, 2023, is not profitable at all. But as we go further into the future, it's less of a problem. Gas is still holding on to profitability further out. Now, one of the things that we have observed in the past few months is that the advantage that coal has over gas has begun to become more and more noticeable further out along the curve. So the impact of the Ukraine and Russia conflict has begun to be felt further out in the longer term. And so it's one of those things that means that we could be in for a long time of volatile markets, because if, say, the Ukrainian conflict ends and things go back towards normal, people will be starting to unwind any decisions they've made 2 or 3 years out and going back into gas, for example, if the gas price comes back down. So it's this volatility that we're seeing expressed in these charts isn't just today, it's going to go on for quite a while. Next slide, please. Looks like that was the last one.
Yeah, Alexander, this is the last one.
Right. Thank you. I'm happy to take questions.
Oh, great presentations from Ingvild and Alexandro. That is indeed from Portugal. It's very important, this discussion between the future of gas and coal, because we just phased out coal last November, and still there are some voices that we should reactivate one of the power plants. Still, the government decision is not to go ahead with it, but indeed these insights are tremendously useful for us to understand the complexity of the markets. And even yesterday, we had the Renewables Portuguese Association telling that with the 60%, around 60% of renewables that we had in Portugal in 2021, the Iberian market was able to save around 300 euros per family due to the percentage of renewables that we have in the electricity market. So there is indeed a huge complexity here that Alexandro and Ingvild just showed us. Just let us see what questions we have. There's already one in the chat, and I would prefer to give the floor to people beside myself going forward with questions. So David Lee just asks, what's your view on the conflicting net effect of more coal burn but possible demand destruction? You can also look at the chat to see how to answer. Let's start this one with Alexandro and Ingvild, and please, you can write in the chat more questions, or you can raise your hand and I will give you the floor for any participant that wants to intervene. Alexandra.
Right. I think certainly the net effect is, you could argue that it might balance itself out. It really depends on how many countries decide to postpone their anticipated phase out of coal, and how many of them actually actively reopen plants that have already gone into reserve or closed. In Germany, I believe it's plants that are in the reserve that are being deployed. I'm not sure that any country has actually taken a plant that's been shut and then decided to reopen it. So it's a tough one, and there are estimates that vary about how much this impacts demand for emissions. Some have said as many as 200 million tons of extra demand would come from the resumption of coal burning across Europe. Now, in terms of demand destruction, we've already seen a little bit of that, because when the gas price crisis last year got to its worst point, there were a number of very large industrial facilities that use gas, ammonia plants, fertilizer plants, steel, zinc. All these manufacturers were immediately said, we're suspending operations. And this was for as long as 2 or 3 months in some cases. So demand destruction is very real. I don't know that it's necessarily continued, but it's certainly, I mean, governments were giving some support, or decided to give support to industry to keep some of those plants open. But the risk is very, very real. And if gas prices stay at the levels that they are at now, with next year's gas is 60, 70 euros a megawatt hour, we could see a lot more plants just basically saying we're not making enough money, or we're not making any money, and decide to go on downtime. In the overall balance of this, we are going to see a reduction in demand, and I think that's certainly the projection that we've seen. I think there's an article, a poll of analysts that said the average projection is for like a 9% decrease in emissions in 2021. That's a big decrease. And I think that we might not see such a big number in this year, but it will still be a decrease again, I think. So I think the net effect is a decrease of emissions. I don't think that there's enough coal being burned at plants across Europe necessarily to overcome the decrease in demand from industry.
Ingvild, can you go ahead? And then we have
Yes.
2 more questions in the chat, particularly for Alexandra, but also for you.
Yeah, so it's I I think kind of we have to acknowledge that Europe doesn't have that much coal now that is not running at full steam. And even that was kind of the situation before of the Ukrainian war as well, because it was a super stressed gas market. Partly because of low Russian gas supply to Europe. So in that sense, kind of how much more coal can you actually burn? But I think, just looking back to when we had in 2020, when we had demand disruption due to the Corona shutdown, you of course had lower power sector demand because kind of the economic activity and industrial demand also went lower. But then we had kind of a very kind of oversupplied gas market with low gas prices. So in that sense, in 2020, you were running gas at full steam, but now you're not doing that at the same time. So that they will kind of level it a bit out. And I think it's a bit too soon to really kind of give good predictions on how hard industry is hit or will be hit going forward. Now it's, we see the signals, we see kind of industry is struggling and the struggle is real, but how severe it will be. But I think kind of if I should kind of just give kind of a gut feeling, is maybe that we're looking at a year that we will see could go for a slightly decrease because of economic downturn in Europe.
Alexandra, let me ask you now on the two issues that we have in the chat. One, what do you think of Lawsons steel's price projections and the role of speculation in the EU ETS? One question is from James Aitken and the other from Sam from Carbon Market Watch. Oh, I see Alexandra is still here, but yeah.
I was on mute. James, Lawsons Steel's projections are logical and rational. If you look at the market, if you take the market 1 year at a time, it is true to say that the EU issues or has been issuing fewer allowances and auctioning fewer allowances than there has been demand. However, I still have a problem with the fact that we have this existing surplus of 1.5 billion tons in the market, and the demand will be met at pretty much any price point going up the chart. There will be a seller and there will be a buyer, going higher and higher. So I'm not sure that the market necessarily would get to 110, 115 euros before there was widespread speculative cashing out. I think they would all see that as a target price to get out. So I also, the events have proved that we can't get to 100 just yet, and we have now got significant economic uncertainty. We have the high gas prices, which should be supporting carbon, but aren't really doing that job. So it's one of those things that it's the high end of the projection range, and it's the logical limits, but I don't think we get there. Sam, your question about speculation, yes, it has become more and more of an issue because it is the only simple way for people to complain about the EU ETS. It's a market mechanism, and therefore it invites speculation. I think the problem is that, first of all, speculators represent a still very small part of the market, but a very active part of the market. And I think that the report that ESMA published yesterday raised a few more interesting issues. But let's deal with speculation first. The market is really about delivering allowances to where they need to be. And they need to be with industrials. Industrials are not trading companies. They buy them and they keep them for compliance every year. So they have no need to trade them. They just need to buy and hold. The Commission doesn't trade them. The Commission mints these EUAs and delivers them into the marketplace to the auction and in free allocation. So this market, the natural buyer of this instrument doesn't trade them. So the actions of those who do trade them have a much bigger impact on the price than they might otherwise do. And I think that that's the problem that politicians have not yet really understood, is that when you need price discovery, you need people to trade it. So these guys have an outsized influence, these speculators and these high frequency traders. They have an outsized influence on the market, but they are a very small part of it. So we're kind of stuck between the devil and the deep blue sea on this. If you want to have a liquid, transparent price, you need these participants. That's the problem that I have there. With Article 29A, I can see a case for changing it, but I'm not sure that necessarily the article would be triggered, even with the new amendments that they're proposing.
Ingvild, do you want to add on these two issues?
Yeah, I think I'm not commenting on someone else's price forecast, I guess. But I see it's a question, so can the market actually deliver the desired result, given that prices obviously need to be higher? But I think it's not necessarily that you need a price that will trigger the abatement option today in the 10 years time. I mean, but I think the price increase that we have seen over the last, over the last few years, and really kind of brought back this confidence that you will actually get the price that will deliver this price to go to kind of this low carbon economy or low carbon future. I think the certainty that you are heading that direction, it will kind of give the price signal that you need. So it's not necessarily that you will take the investment decision today, that you need kind of, for instance, the CCS price in order to kind of factor in a higher price in the future. So I think kind of this certainty that you will kind of have a system that is set up in a proper way. It will kind of be tighter in the future. It will kind of meet the objectives of the European climate policy, because I mean, that has been a problem before, that I mean, policy hasn't been bold enough. The EU ETS has maybe kind of has its flaws as well, but it's now kind of believing that a kind of climate ambition and the climate policy is bold in the and so or kind of that's that EU ETS is responding to. So it's not necessarily that you need the price that will trigger the expensive abatement option that you will eventually need, but I think kind of the prospect that that's where we're heading, and that's where we're going to be. I mean, we have the climate neutrality goal for 2050. I mean, if you are to survive in Europe as industry, or I mean, that's, you know, that you have to go that direction and take the investment decision based on that.
So you're somehow confident as the vice president of the commission, that Timmermans, that we, even though with these temporary differences due to the Ukrainian war, we're still in line with the carbon neutrality goals, and that is actually one of the questions that we have in the chat. Is with bringing coal from other new places, coal that is more pollutant, less efficient. Are we? And this is just the last question before I give the word to Sam from Carbon Market Watch. With all the balances and the complexity that you both showed in the EU ETS, are you and of course with variables like the decrease of the economic activity, you do believe that the long-term goal and the performance of the EU ETS is still assuring us that we're going towards carbon neutrality in 2050 and the 55% reduction between 1990 and 2030, or can we actually have a reverse of the climate policies with the latest developments? Maybe Ingvild, you can start, and then I give the final word to Alexandra.
I think, I mean, this Ukrainian war and the crisis we have in Europe at the moment has really kind of emphasized kind of the need for a green transition. That kind of, I mean, that's really, I mean, if we were further ahead, then we would have kind of less reliance on fossil fuels, which is kind of, I would say, even before we had the war, you saw kind of big demand from Asia, from Southern America, it's suddenly kind of a global commodities that are kind of, we are competing on the same line as everyone else. Before kind of everything was coming to Europe as we kind of had the demand, but when kind of demand is growing elsewhere as well, we are kind of also competing. So that's kind of giving a pressure to electricity prices. So I think this and kind of the war has really kind of emphasized that it's a risk to be reliant on fossil fuel. And that's kind of, if we want to free ourselves or kind of make Europe more resilient to these threats, then it's probably kind of the greening of, for instance, the power sector is the way to go. So I think it's, I mean, we haven't really seen any signs that we are kind of losing kind of the sight on the climate target. Of course, I mean, we're in the EU ETS review. I mean, we're in the review of all legislation that will kind of be help to meet the 2030 target. And of course, there are elements in there that will be, even though the final goal is fixed, there are kind of elements in there that can be kind of a big importance on how effective the EU ETS will be. For instance, the design of the market stability reserve is kind of one of the key elements that, I mean, we haven't seen too much discussion on what has been proposed by the European Commission. But of course, if you start to kind of weaken that, you can still meet 2030 target, but then kind of the effect of the ETS will not be kind of as substantial as probably we need to get the transition moving. And I think it's also kind of this acknowledgement that the EU ETS is a cash cow. I mean, it's a revenue stream for countries, for modernization fund, for innovation fund, these kind of fundings that is necessary to do the shift. And I mean, we saw that as kind of when the European Commission came out with their toolbox on how to kind of solve the energy crisis in October, that the EU ETS was actually revenues from the EU ETS was kind of one of the things that they were kind of proposing to alleviate some of the high electricity costs. So I think kind of the revenue element is quite important also for the EU ETS too. So kind of to weaken that will also be tricky for policymakers that are going to fund this transition.
Yeah, the transition is really the key word for climate. Alexandra, final words in this debate?
Thanks. I would take also the view that it's not just the Fit for 55, but it's the Green Deal that goes across every part of the economy. And if you look at the various proposals under the Green Deal, climate runs through it all. Climate is part of the entire package. And yes, the practical issues of the Fit for 55 package, you know, is very much EU ETS focused. But let's not lose sight of the Renewable Energy Directive that's going to be, you know, retooled, the Energy Efficiency Directive that's going to be reformed and upgraded. These are all driving us in the same direction. And yes, the EU ETS is going to do its part. And it does its part very well, I think. I mean, it sends a signal to the entire economy that the lowest cost abatements, the lowest cost reduction of emissions is possible. and it's been working. Now, what we need to see in the coming years is how it moves into the field of industry, because a lot of commentators and a lot of analysts have said, look, the industrial abatement has fallen behind. The work has been done by the power sector so far. We need also the industrial sector to do some work. Now, obviously, at a time when we have high energy prices, that's not going to be an easy solution to get to, but it's where we have to go. And maybe renewable energy is going to be one of the driving forces that helps us get past the energy security issue and allows the EU ETS to drive industrial abatement as well.
Thank you very much to both of you. And now a final statement from Sam van der Plas. Carbon Market Watch is the organization coordinating this ETX project under the LIFE program. So Sam, please go ahead.
Thank you, Francisco, and many thanks to Ingvild and Alessandra for helping us to shed some light on these complex topics. I guess everything happening against a very dark backdrop of a war and an invasion in Ukraine. Actually focusing and sharpening the focus on the role of fossil fuels in driving conflict, and what that means for the climate crisis developing. And I guess it's fair to say also within the EU ETS this creates turmoil. I mean, both of you helped to shed some light on kind of I guess the old paradigm, looking at fuel switching in the energy mix in Europe, and then what that impacts on the demand of allowances as soon as coal is more profitable to use than CO2 prices have gone up in the past, and a new paradigm which is maybe not defined yet. I think Ingvild outlined that very well. This kind of decoupling we have seen from carbon and the broader energy mix, coal being more profitable right now, emissions going back up. I think it's fair to say that whatever happens next, the role of the ETS and how it will be reformed will become a major focus again, in the sense that it's about creating resilience inside the carbon market. You both spoke to the importance of the market stability reserve, also helping to dampen the supply demand shocks we have seen and we might see into the future. But I guess also outside the carbon market, the broader European climate ambitions, the policy mix going forward, how renewable energy savings are being supported in the discussions around the Green Deal. And I would even add one to this, which is the Industrial Emissions Directive, not only regulating the power sector, but also energy intensive industries, currently when it comes to their non-CO2 emissions. But as far as we're concerned, that needs a sharpened focus on CO2 emissions as well. So I guess my lazy conclusion could be, in the future, prices can go up and can go down. But at the same time, it's clear that the direction of travel is also clear ahead of us when it comes to tackling the climate crisis and the need to reduce emissions in the longer run, and the ETS as one component of doing that. I guess we still don't have a crystal ball, but as far as crystal balls go, we definitely had a great look into the dynamics and how also the analysts look at these developments on a daily basis. Again, many thanks to Ingvild and Alessandra for helping to shed some light on this, and we look forward to the next occasion and staying in touch. Thank you.
Thank you all of you for participating, particularly Alexandra and Ingvild, and of course also Sam. And if we will share the recording and the slides if the speakers allow us. and also acknowledgements to my colleague Carolina. And that's all for now. We will have a fourth ETS talk for sure. And thank you very much for all of you for this 1 hour and almost 20 minutes of discussion of the EU ETS and the crisis we're living on. Thank you.
Thank you. Bye-bye.
Thank you. Bye.